4, 3, 2, 1. On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and my colleague, Tobin Smith, is still away on assignment. We do hope he returns next week. But joining me today is Jose Torres. He is the senior economist at Interactive Brokers. And Jose, we have this government shutdown. We're now getting word that you're going to have federal government employees that could very well be losing their jobs. They're not even furloughed. They are actually being terminated from their jobs. You would think also this will have a direct negative impact on GDP. Yet the stock market hits a record high. What the hell is going on?
Well, Todd, great to be here. Hello, everyone. What's going on now is that the silver lining of the downsizing efforts in the government actually point to lighter term premiums and a better fiscal situation. When you consider in the beginning of the administration, when you had Tesla CEO Elon Musk driving the Department of Government Efficiency efforts, those moves and those ambitions sort of were abandoned for several months after Tesla CEO Musk walked away from the administration. Now they're starting to come back into focus, and term premiums, and that really quantifies the level of concern that investors have over the nation's fiscal budget. They're way down this year. We're talking about 3 consecutive quarters of a rally in treasuries, not just a rally in stocks, but also a rally in treasuries. So I think what equity market investors are saying, whoa, government downsizing efforts, this means that the 10-year can be at 3.5% soon. That can help to alleviate the valuation excesses worked in stocks. And then also you had the OpenAI news this morning, record valuation, world's most valuable startup. That led to investors strengthening their confidence that the AI revolution is still in its early innings. And all in all, that served for higher stock prices today and new records.
So do you believe that we will see a 3.5% yield on that 10-year treasury?
I certainly hope so. And I hope, Todd, that it's not because of an economic slowdown. I hope that we're continuing to grow strongly and that inflation retreats to the mid twos like it did during Trump 1.0 in the first Trump administration. We saw inflation rise up to 2.9, 3%, only to retreat back to the low twos after we had some strong economic growth and servicers were able to absorb the strong consumer demand, which naturally drive some price pressures. When you have so many folks walking into the door wanting to consume services and goods, businesses, if they're caught a little offsides, if they don't have the inventories, don't have the capacity, don't have the employees, they lift prices a little bit, but then over time that tends to retreat. And that's the same thing we're seeing now, Todd. This inflation we're seeing, Todd, has nothing to do with tariffs, not concentrated in goods. It's services. It's the discretionary areas, hotels, flights, restaurants. Those segments are seeing the inflation, and that's why we got that big upward revision in the second quarter GDP to 3.8%. Second half of the year was looking better, Todd, but now this shutdown, at least for short-term economic prospects, does pose somewhat of a potential containment. We're not going to reaccelerate as fast as I've hoped if this shutdown lasts a long time. Call it more than 15 days.
Okay, there's a lot to unpack here. I want to address that last statement there right away. If there is a prolonged shutdown, we already know there's going to be a negative on GDP. We already got that. But what happens with the Fed? As you know, they're meeting in 4 weeks. So you have a labor report that is not being distributed tomorrow. You're going to have CPI numbers that won't be distributed, PPI. There's a lot of data points that the Fed relies on that they may not receive. If that's the case, what happens at the October 28th meeting? Do they just cancel the meeting?
No, 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 no. They cannot cancel the meeting. They are going to continue cutting. They're going to work with the data that they have, Todd. They still have data. The BLS data, okay, they'll be out for a few weeks, maybe a month or two. Hopefully not. But you have a lot of other data. ADP data on Wednesday reflected the sharpest job losses in 30 months, 2.5 years going back to March 2020. 2023 rather, sorry. And on top of that, it was the third month of job losses in four. We lost jobs in June, August, and September, according to ADP. July posted a climb. If those were the BLS numbers showing that level of weakness, the Fed would have cut 50 basis points in October, in my opinion, right? But because we're not going to get those numbers tomorrow, the move is likely to be a 25 because the ADP report doesn't hold the weight or the prominence than the traditional BLS report. And that's the risk here. The Fed is going to be flying blind, not really knowing if the labor market is deteriorating too rapidly, which would justify a bigger than normal reduction like last September 2024 when they did 50. And then also, like you said, you don't get those inflation numbers. So what if inflation misses to the downside significantly, but we don't know, right?
Yeah.
Then all of a sudden the Fed maybe, is more restrictive than it needs to be. But if you look at the ADP report on its own, right, we are clearly way too restrictive than the Fed ought to be cutting at the next few meetings.
Now, how crazy is that statement? Because ADP for some time now has just been not even second fiddle to the BOS report. A lot of people have just ignored it because it's a smaller percentage of showcasing job creation, and more importantly, it has never been very accurate when it comes to Wall Street expectations. But now all of a sudden, it is the holy grail of labor reports because it's the only one that we're getting. So it is a bit dysfunctional if you think about it. But let's go to that. BOS talks about job growth. One thing that we didn't get today were jobless claims, which come out every Thursday, as you know, Jose. And so with that, and you're now talking about labor cutting in the federal government, why weren't, if these people could have been cut, why weren't they cut many months ago with Doge?
Well, I thought that Tesla CEO Elon Musk was just way too aggressive in his downsizing efforts, and he's much more of a fiscal hawk than really anyone in the administration, much more of a austere kind of mindset than President Trump. Remember, Secretary Treasury Bessent and Elon Musk, it's on the record that they had some heated arguments around the White House because he wanted to cut way more aggressively than what the appetite called for in the administration. So, I mean, that's why I think that a lot of those cuts weren't implemented early, albeit some did, and you did have that program that allowed federal workers to choose to take the buyout offer. So we did have some, but we didn't have a significant amount because it's a balancing act, Todd. You don't want to. Sure, you want to balance the budget and you want to lower interest rates, but you don't want interest rates going down because of, like you said earlier, because of weakening GDP. You want interest rates to go down because of an improving fiscal situation and because of softening inflation expectations, not because growth is going to hell. That's not what we want to see. And that's why I think that no one really had the appetite of Musk's speed to want to cut drastically. He wanted to do similar to what Javier Milei did in Argentina. Come out with the scissors and really cut drastically. And there's big risks to that. January 1st, New Year's Day, I told CNBC that I expected President Trump and Elon Musk to bump heads over this because President Trump at his core is not a fiscal hawk. He's more of a crowd pleaser and he's more of a stimulator.
Yeah, it's a valid point. On the jobs, one last thought on this. Immigration. Now, we have been conditioned in this country to expect six-digit job growth every month. And now with the population for the first time in American history, looks like it's going to decline rather than grow this year. If that's the case, should we start resetting our expectations to start looking at maybe mid to low five-digit numbers going forward?
Yeah, I think so. Absolutely. And then another big driver before we talk more about immigration is also AI. AI is also containing that progress. And that's why we're in this market where if you have softening jobs numbers, investors don't necessarily think that the cycle is over because firms can employ AI to do a lot of the tasks that those potential workers could have done. And then as far as immigration, absolutely, our birth rate is particularly low. We've been years, we've been importing laborers, and our labor pool has been expansive because whenever we find workers, there's tons of them able, willing, and reliable. But now, of course, that's a lot more limited. And for that reason, jobs numbers, like you said, Todd, are going to be 50,000, 30,000, no longer 200,000, 300,000, et cetera.
Okay. Yeah, I think we had a little bit of technical difficulty there, but for the most part, we got your message. So let's move forward from this. So we know that we're not going to get any key metric numbers to really analyze and discuss on these shows. So we kind of have to make it up as we go. But the stock market right now, what you're suggesting is that traders are bullish and optimistic because they're looking at the bottom line number as far as these other people that are going to be out of work. But as you know, if people are out of work, they start collecting unemployment, they're not going to have a lot of cash to spend. So the fourth quarter has always been our strongest quarter. What do you think, though, or what are you projecting right now? Or do you have to revise your projections for the fourth quarter now that the government is in a shutdown?
I still think that the fourth quarter is going to be buoyant because despite the government shutdown, Todd, all the bullish things that we've been talking about all year, they're still going on. Lighter taxation, milder regulation, subdued energy costs, a really pro-growth, pro-business environment from the political backdrop. So, all in all, investors are still looking forward, looking ahead, pulling forward the earnings from 2026, 2027, 2028. Profitability has been stabilizing. So investors feel fine climbing up the valuation ladder, paying a little more expensive prices because they know that a lot of the firms, the Magnificent Seven, are going to be able to consistently grow profits despite what's going on in Washington or the political backdrop. Also, a lot of those federal workers, highly skilled, they're going to be able to find jobs in the private sector, despite the macro data weakening. Part of the reason why the macro data is weakening is a labor supply issue, not necessarily that labor demand has fallen off a cliff. So I think that a lot of those federal workers, if they are laid off permanently, they can come to the private sector and they can find a new home.
Let's turn the page on to tariffs right now. Now we have so many more tariffs than we did the last time you were on our shows. So what is when you're calculating the numbers as far as the amount of revenue the country is bringing in, are we chipping away at that $36 trillion deficit? Or if we're not, then how much more in tariff revenue do we need to make a dent?
I think we're definitely chipping away at it. Numbers have been roughly 30 billion a month. They annualize at around 360 billion. We got to wait and see. There's been some bumpiness. But I think that definitely moves the needle significantly. It helps to narrow the budget deficit, and that's what's really driven the Treasury rally. You've had softer term premiums and you've had softer inflation expectations. So I think that it's going to be a huge help. And then if all of a sudden, if you start saving money on the federal government expenditure side, that's helping on the cost side while the revenue side is getting a good boost. And then hopefully tax revenues go through the roof because of buoyant economic growth and this terrific economic environment that we're in. 3.8% second quarter GDP growth, folks.
Yeah, that's solid, no doubt about it. And what is the number right now? Because it back in the 80s and 90s, we had to grow at a 2 to 2.5% growth rate annually just to keep up with population growth as far as providing enough jobs for the population. Has the annual number been skewed at all because of immigration?
Um, I would say that overall, immigration in the last administration served to be somewhat of a tailwind from the consumption and the labor market side. But now you're starting to see tailwinds come from the capital expenditure and the investment side. And I think that's really going to be much more supportive of stronger growth going forward. Also, the lighter taxation, that's also going to help more so offset the headwinds of immigration this time. In the first Trump administration, we had quarters growth in excess of 4%, 4.6% or so before the pandemic in one of those quarters. So I think we're going to have quarters just like that this time around too, in excess of 4%, because just the animal spirits and the winds are just too strong, and really the pace of GDP advancement isn't really that relevant when you consider this president and this administration just wants to grow the economy and grow the stock market as fast as it possibly can while it's in office. But I would say a growth rate between 2 and 3% over time with this economy, that would be reasonable.
So as you know, Jose, economists, they have to take data, the current data, and then try to forecast future events. So where that last question for you was really not just meant for you, but also for members of the Fed. I know they're not full of economists. Jerome Powell, for example, is a lawyer, but don't they have to start changing their data points? Because it's one thing to look at history and how we've always processed this data, but now we have to analyze it in a different way where you actually have an American population that is decreasing. Do you think that perhaps we're not really fully aware, or we're just simply looking at past events rather than thinking a future population, lower population as far as impacting our numbers going forward?
I think that we have a lot of examples around the world. When we look at China, they've had significant population issues. Europe has had significant population issues. And those right there are bifurcated. The Chinese economy grows roughly 5% a year. It's an emerging market economy. The European economy grows a lot slower, maybe 1% or a lot less. So I think it's reasonable for us to be somewhere between that 1% for the EU and 5% with China and stay right around 3%. But you're absolutely right. The population decline is particularly worrisome. It's a demographic issue. Japan's also dealing with it. As far as what you put into your numbers, if we get a Democrat in 2020, winning the 2028 election, you'd expect the immigration numbers to shift drastically the other way. So that's why I don't think folks are really paying attention to it to that point from a longer term perspective. They're just thinking, oh, once President Trump is out of the White House, and perhaps if a Democrat wins in 2028, then presumably immigration will come back, or if they win in 2032 or 2036. So I think that's the mindset. Yeah, that's pretty much all I have to say on that topic.
Okay, no, that's very smart. It's a very smart response. Back to the tariffs. Do you see the U.S. maybe pulling back on the tariffs, especially in 2026, as more countries come to the table and want to work out deals? Or is this just going to be the new norm going forward?
I think the new norm is fine. You have an average tariff rate of 15%. That's nothing crazy. That is totally fine. It's been unfair for America on the trade playing field globally. Folks implement tariffs on us. They have value-added taxes. They have tons of restrictions. They have currency manipulation tactics. And, we've been free traders against that backdrop. It's time to neutralize that, buoy American manufacturing, and make things a little fair. So I think 15% average tariff rate is fine, much higher for some of the more aggressive players and partners. But I'm fine with 15%, Todd.
Is there a specific number, though, from a tariff percentage that could negatively impact GDP?
Oh yeah, 25%, that would tank us into a downturn. 25%.
Interesting. A recession, I presume you mean.
Yeah. I didn't want to say that, but yeah.
That's okay. I'll say it for you.
And the reason, Todd, why is because on Liberation Day, that's where the numbers were when I was calculating, when President Trump came out with the board and I was calculating the numbers down the list. It seemed like an average of around 25%. And as we saw, the markets couldn't take that because there's no way that the S&P 500 constituents are going to make their numbers in aggregate with a tariff that high. But 15%, it's almost half of that, and it's much more tolerable.
Okay. Jose, we're going to leave it there. I do have one final question for you. As you know, it's game 3 tonight between the Yankees and the Red Sox. What are your economic models saying of who's going to win tonight?
I think the Yankees are going to win. I grew up in Queens, so I'm upset about Mr. Met hanging himself next
Yes.
to Citi Field. But I'm going with the Yankees on this one.
Okay, all right, very good. Very, you might be onto something, but we'll talk about it the next time you're on. So, Jose,
Terrific.
thank you for joining me today. We definitely will have you back, obviously, as we move further into Q4, and hopefully we'll have some data points to talk about then too.
Absolutely. I have a live event tomorrow about the jobs data, and I have to talk about everything else.
Good luck with
Take
that.
care.
So, on behalf of Jose Torres, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care. All right, we are out. All right, Jose, that was awesome. Hey, Jose.